Hello everyone. Welcome to our channel. Today, we're going to talk about a very important topic for those who want to learn to invest: diversified portfolios. If you've ever wondered how to protect your investments and maximize your gains, this video is for you. So, stay with us. But before we dive in, let me ask you a question. Did you know that putting all your eggs in one basket can be very risky? Today, we're going to discover why diversifying your investment portfolio is key to your financial success. Let's start with the basics. A diversified portfolio is a collection of investments that includes different types of assets, such as stocks, bonds, real estate, and others. The main goal of diversification is to reduce risk. But why is it so important? Imagine a scenario. Suppose you decide to invest all your money in a single stock of one company. If that company runs into problems and its shares fall, your investment will be severely affected. Now, if instead you invest in several companies from different sectors, like technology, healthcare, and energy, the impact of a drop in one specific sector will be much smaller. This is because different investments don't always behave the same way. This is where the concept of correlation comes in. Some assets, like stocks, may move in the same direction at certain times, but others, like bonds, can offer stability when stocks are falling. Therefore, by including different types of investments in your portfolio, you can smooth out volatility and protect your capital. Now, let's talk about some concrete examples. Suppose you have £10,000 to invest. Instead of putting all that money into a single stock, you could distribute it as follows. 1. Stocks, £4,000 in a mix of growth stocks and dividend stocks. 2. Bonds, £3,000 in government bonds and high-quality corporate bonds. 3. Real estate, £2,000 in a real estate investment trust. 4. Commodities, £1,000 in gold or silver. By doing so, you're diversifying your risks. If stocks fall, your bonds might stay stable, and your real estate investments can continue generating income. Plus, if the commodities market rises, your gold investment could benefit. But be careful, diversifying doesn't mean just having a bunch of investments. It's important to find a balance. An overly diversified portfolio can become difficult to manage and, in some cases, can dilute your gains. That's why it's crucial to make an appropriate selection of assets. Another important point is that diversification isn't a one-time event. You must review and adjust your portfolio regularly, especially when market conditions change or your financial goals evolve. This is known as rebalancing. By doing so, you ensure your portfolio remains aligned with your investment strategy. Now, it's essential to understand that while diversification can reduce risk, it doesn't guarantee profits or completely eliminate the possibility of losses. Investing always involves some degree of risk. However, a diversified portfolio is one of the best strategies you can adopt to protect yourself against market uncertainty. In summary, a diversified portfolio is a powerful tool for investors. By spreading your investments across different assets, you can reduce risk and increase your chances of achieving stable long-term returns. Remember that diversification is an ongoing process, so stay on top of your investments and adjust them as needed. If you enjoyed this video and want to learn more about investing and personal finance, don't forget to like and subscribe to our channel. Also, leave a comment below on what other topics you'd like us to cover. Thanks for joining us today, and see you next time.